Section 8. Unit 3, FHA Underwriting Guidelines. Introduction and Objectives. Lesson 1, Borrower Income Requirements for FHA-insured loans. Lesson 2, FHA Loan Underwriting Guidelines. Lesson 3, FHA-insured loans and mortgage insurance premiums. Lesson 4, FHA loan limits in California. 2 types of MIP, video transcript. On an FHA-insured loan, the borrower pays a mortgage insurance premium, or MIP, in 2 forms. An upfront MIP is paid at closing, and an annual MIP is paid over the life of the loan. Both forms are required on all FHA loans. The upfront premium is a percentage of the loan amount stipulated by the FHA. This can be paid in cash at closing by the borrower, or it can be financed with the loan. If the upfront premium is financed, it becomes part of the principal of the loan, increasing the principal balance. The annual MIP is also a percentage, but it's based on the amount of the loan-to-value ratio, and the loan duration. It's recalculated each year because those amounts will change as the mortgage is paid off. The annual MIP is divided by 12, and that amount is added to the borrower's mortgage payment each month. FHA Mortgage Insurance Premiums. So, FHA mortgage insurance requires borrowers who are obtaining an FHA loan to pay an upfront monthly mortgage insurance premium, MIP, as well as an annual MIP, which is divided into 12 monthly payments. Both are percentages of the loan. The upfront MIP is a percentage of the base loan amount. The annual MIP is also a percentage, but it's based on the amount of the loan-to-value ratio, and the loan duration. Over the years, the FHA has adjusted the percentages for both the upfront and the annual MIP. Let's look at how MIP works with an FHA loan. Example. Your client, Paulo, is buying his first home, a condo, for $100,000. He's making the minimum down payment for a 30-year FHA loan. At the time, the upfront MIP is 1.75%, which he's going to finance, and the annual MIP is 0.85%. Here are the numbers you ran to help Paulo get his brain around the different costs. Purchase price of the condo, $100,000. Minimum down payment allowed by FHA rules, 3.5%, $3,500. Base loan amount, $100,000 to $3,500 equals $96,500. Upfront MIP of 1.75% of $96,500 charged at closing, $1,689. Financed upfront MIP amount added to the base loan to get the total loan amount, $96,500 plus $1,689 equals $98,189. Annual MIP amount, 0.85% base loan amount times 0.85% equals $96,500 times 0.85% equals $820.25. Annual MIP amount monthly payment, $820.25 divided by 12 equals $68.35, which will be added to each month's mortgage payment of principal and interest during the first year. Note that the annual MIP calculation uses the base loan amount, not the total loan amount, which includes the financed upfront MIP. The annual MIP is recalculated each year using the end-of-year loan balance, plus the balance after the next 11 payments. The MIP amount will decrease each year as the loan balance is paid down. MIP versus PMI. MIP is different from private mortgage insurance, PMI, in that it's not automatically removed after the homeowner has earned a sufficient amount of equity. For most FHA loans originated since 2013, borrowers pay the annual MIP as long as the loan is active, meaning until the home is sold and the balance is paid off. The loan is paid in full through amortization, or the borrower refinances with a conventional loan. However, the upfront MIP can be partially refunded if the homeowner refinances within 36 months of closing and uses the FHA Streamline Refinance Program. Underwriting Guidelines for FHA Loans. Lenders that offer FHA-insured loans must meet underwriting standards, which can be pretty complex. It's not necessary for you to learn all of the underwriting requirements, but a general understanding of the underwriting standards is useful for any real estate professional. Down payment requirements. Since January 1, 2009, FHA borrowers must place 3.5% as a down payment. This amount is calculated on the lesser of the sales price or appraised value. This may be in the form of their own funds, a family gift, or a grant from a local, state, or nonprofit down payment assistance program. The FHA does scrutinize the source of down payment funds and doesn't allow the seller to contribute to the buyer's down payment. For some programs that allow for a higher loan-to-value ratio, LTVR, a portion of the 3.5% may be used toward approved closing costs. Loan limits. The FHA limits the loan amount it will insure based on the type of structure, e.g., single-family versus multifamily, and median home prices in the area. Mortgage limits are reviewed annually and can change every year. The FHA won't insure loans that exceed these limits, and therefore lenders won't lend on them, not for an FHA loan, anyway. Loans that exceed the FHA limit are considered jumbo, non-conforming loans, and they're not eligible for sale to Fannie Mae or Freddie Mac. Buy-downs. Borrowers or sellers may buy down the interest rate for a period of time, which will reduce the monthly payments for that period. This lower rate may help some borrowers qualify for the loan. Seller-paid closing costs. One reason some sellers balk at an FHA buyer is that the FHA strictly limits the closing costs that may be paid by their borrowers so that the loan remains affordable. This may increase the costs that the seller will be required to cover in order to make the sale. The FHA allows the seller to contribute up to 6% of the sales price, or of the appraised value, if that's less, toward the buyer's closing costs, prepaid expenses, discount points, and other financing costs. Costs that can be included in this 6% limit are permanent and temporary interest rate buydowns, payments of mortgage interest for fixed-rate mortgages, mortgage payment protection insurance, which covers mortgage payments for a set period if the borrower is out of work due to accident, sickness, or unemployment, payment of the upfront mortgage insurance premium, UFMIP, second mortgages. If a homeowner with an FHA loan wants to obtain a second mortgage on the property, the total of the first and second mortgage must be within the maximum LTV ratio. The borrower must qualify to make both payments. Toxic loan features, such as balloon payments maturing within 5 years, highly variable mortgage payments, and prepayment penalties, are not allowed. Assumptions. FHA loans don't use a due-on-sale clause, so it's possible for borrowers to assume an existing FHA loan. If the loan were originated before December 1986, it can be assumed without the new borrower having to qualify. For loans originated after December 1986, the borrower must pass a creditworthiness review before being allowed to assume the loan. Investors may not assume FHA loans. The property must be owner-occupied for the life of the loan. Qualifying income for FHA loans. George and Betsy want to buy a house, though they wish they'd saved more money for a down payment. After weighing the pros and cons of a conventional mortgage with an FHA mortgage, they decided to apply for an FHA loan through an FHA-approved lender. Their mortgage broker explained that an FHA loan may allow a lower down payment than what's required for a conventional loan with slightly lower interest rates and more flexible credit qualifications. George and Betsy like the idea, so Mike explains the qualifying requirements for FHA loans, telling them that FHA qualifies borrowers using two types of income ratios, and that they must qualify under both ratios to be eligible. The first ratio is a housing ratio of 31%. George and Betsy's total housing expenses can't be more than 31% of their total gross monthly income. The expenses that are included when calculating this ratio are mortgage, principal, interest, property taxes, home insurance premiums, mortgage insurance premiums, homeowner or condo association fees, if applicable. George and Betsy's total monthly housing expense, if they get the loan they're applying for, equals 30% of their gross monthly income, so they qualify on that count. The second qualifying ratio is total debt obligations, also called the debt-to-income ratio. Their housing expenses, the ones that went into calculating the first ratio, plus any recurring debt, student loans, credit card payments, car payments, must not exceed 43% of their gross monthly income. They don't have much debt, luckily, and their second qualifying ratio works out to be 38%, well within the guidelines. If they'd exceeded those guidelines, sometimes compensating factors such as excellent job history, a larger down payment, additional income potential, etc., would still allow them to qualify. George and Betsy also must have a credit score of at least 580 to qualify for a 3.5% down payment. Borrowers with scores as low as 500 may still qualify, but they'll have to put at least 10% down. Lenders prefer a score of at least 620. In this case, George and Betsy have a perfectly acceptable credit score of 710.